To keep yourself updated, subscribe to Indigo Learn and click the bell icon.
This framework what we have discussed holds good for any item. Now change it. It is not an asset. It is a liability. Okay. Liability. Go to the ledger account. In the ledger account of liability, you have opening balance. Instead of two balance brought down, you will have buy balance brought down. And transaction, you took extra loan in the current period. If you have taken extra loan in the current period, again, come to the audit comfort bucket. First item, test of compliance with laws and regulations. What are all the laws and regulations regarding loans? What does Companies Act say? Check those points, whether they have been followed or not. What do any accounting standard points tell us? Check whether they have been followed or not. Is there any point in Caro regarding this? Check whether it is followed or not. Right? So all those points. Then test of controls. Are there controls regarding who should take a loan, how much loan can be taken, etc. Then are those controls adequate and are they being followed effectively? Then analytical procedures regarding loans, particularly for interest you can carry out analytical procedures. And finally test of details. The moment I come to test of details, straight away I will come to these assertions. Again, existence. Is that loan really our loan? So is that loan really existing? So for that we may go and obtain something called as a balance confirmation from the banker that yes, really this is our loan. So for that we might obtain a balance confirmation. If that loan was taken during the current year, then you will go and check even the loan documents as to what is the loan, how much amount is it, for what are the terms of loan, etc. You check whether it occurred during the current period or not. Then you talk about accuracy. You are checking whether the amount of loan, what is there in the agreement, loan agreement or loan sanction terms, we call them, whether that is the amount that is seen even in the bank statement, etc., which is ultimately seen in the ledger account. All this accuracy you are ensuring. Then completeness, whether the entire loan amount, the closing balance, whether it is currently getting reflected in the books of account. Then you are talking about valuation, the value at which it is shown, is it appropriate or not, you are checking that. Of course, it will get clarified when banker gives a letter saying this is the closing balance of loan. Naturally, the closing balance value will get clarified. Obligation, rights and obligations. Talk about obligation. The banker, when they give a letter, they should clearly write this is the amount of loan from so and so party. So they should clearly write the party's name. So check the name of the entity who took loan, because obligation should have been in that person's name. So if I am the person who took loan, banker should give a letter saying yes, this person owes me so much money. Alright. So obligation, you are checking the name of that particular party on the banker letter, or you call it balance confirmation. Then cutoff. If the loan was taken during the period, see, cutoff is an assertion which is only for transactions which have occurred during the period. So if a loan was taken during the period, then there will be cutoff assertion which you can check. If a loan was repaid during the period, cutoff assertion can be checked. So basically, if a transaction has occurred during the period, it should be recorded. If it has not occurred, it should not be recorded. As simple as that. You are checking that. And finally, presentation and disclosure as to whether it is correctly accounted in the appropriate account, whether it is correctly classified into balance sheet or P&L item, and whether it is correctly disclosed in the financial statements as per the respective framework. Like say company means there is schedule 3 framework, whether it is presented as per that or not. All these points you should check, friends. Once you understand the framework, you can run any number of transactions or items through this particular framework, whether it be fixed assets, whether it be reserves and surplus, or share capital, or purchases or sales, any item you can just run through this beautiful framework. Okay, right. Now friends, this I want you to learn properly, and we have to just remember one more point before going into individual aspects of assets and liabilities, and of course P&L items. It is in the assertions, listen carefully. When you're talking about assertions, existence is always a balance sheet item, is always for balance sheet items. Means it should be for closing balance. Is that closing balance or whatever you see for asset or liability, is it really existing or not? Is it really existing or not? So it's a pure balance sheet item. But occurrence is purely a transaction. What do I mean by transaction? If it is an addition or deletion to balance sheet item, And a purchase of asset happened, can be called as, you can check it under occurrence. Sale of asset happened, whether it has really occurred or not, you are checking, right? So occurrence is for transaction. Transaction means it can be a balance sheet item increase or decrease, or it will be P&L item. So something like sale, whether it has really occurred or not, you are checking. So it is a P&L item. Purchases, have they really occurred or not, you are checking. So that is again it is a point relating to occurrence. Are we clear about it? Existence is always balance sheet item. Occurrence is always for transaction. Transaction means increase or decrease to balance sheet items, and all the P&L items come under occurrence. Then accuracy is for both balance sheet and P&L. Completeness is also for both balance sheet and P&L. Valuation again is exclusively for balance sheet closing balances. The value at which they are carried in the balance sheet, whether that value is appropriate or not. So valuation again is for balance sheet closing balances. Then rights and obligations. I told you that right means an asset is generally the right of the entity. Liability is the obligation of the entity. Now, what about incomes? Incomes are the rights of the entity. Expenses are the obligations that we have met for the entity. So basically, incomes, expenses, of course, expense, even if obligation is not paid off, still it can come under expense. So you are checking whether incomes and assets are the rights of the entity, whether expenses and liabilities are the obligations of the entity. So rights and obligations apply to balance sheet items as well as P&L items, right? Come to cutoff. Cutoff is only for transactions. Cutoff is only for transactions. When I say it is only for transactions, it is only for anything which has something like increase or decrease to the assets or P&L items. So only for such points you can check the cutoff. So increase or decrease in the asset, right? So you are saying purchase of asset or sale of asset. You can see whether it is a transaction which occurred during the accounting period, whether it should be recorded here or whether it should be recorded in the next year or whether it should have been recorded in the previous year, you can check. Similarly, when I talk about P&L items, sales, is that sale pertaining to current period? If it is pertaining to current period, it should be recorded in the current period. If it is not, it should not be recorded in the current period. As simple as that. So you are checking all these points under cutoff assertion. So cutoff assertion is only for transactions. When I talk about presentation and disclosure will be more for overall presentation and disclosure in the financial statements level. Okay, so you got an overview of how you have to approach this particular chapter. Let us get started with each of those items. Let us start with balance sheet. Under balance sheet also, let us start with capital, that is equity and liability side, and one by one let us start learning how you can run through this framework.